Hi, everyone, and welcome back to another show. My name is Tyler, and I'm with Matt, the founder of orats. Orats is an options analytics platform built on top of over 15 years of historical options data. And our dashboard is integrated with Tradier, meaning you can research and discover trades on our platform and then seamlessly send them through to your brokerage account. Last week on the show, we focused on finding a double calendar trade on IWM. So today we'll look at how that trade went and then move on to finding a custom skew trade for today. We'll take a look at our new custom option scanner where you can scan on any type of spread that you want. So Matt, if you're ready, do you want to share your screen and go over the IWM trade?
Yep, absolutely. We also we also continue to trade. So here are the trades that we did last time on the show. Can you see my screen okay, Tyler?
Looks good.
All right. So we did a double calendar in IWM. And we also continued our wheel strategy, selling at the money put in SPY. So we'll check out all those. So let's start with SPY. That's a little easier. So we sold that at 349. We'll take a look at where it is now. And then on the double calendars, it was 22-26. So 7 days ago was we had 3 days left in the front. And today is when these are going to expire. So we paid a small amount. We're just going to ride them out and see how it did. We talked about exiting and not exiting. So yeah, let's take a look at now how we're doing today. So here's IWM, and so we have the two options open. So the double calendar was a call calendar at 199. So that was the double calendar. Again, if you go back and review, it looks like this. So there's a circus tent on one side, a circus tent on the other. And what happened is IWM went up to here. And so the call calendar is doing real well. We're going to just let that expire today, but it's our $4. So we paid 50 cents for this spread, and now it's worth $4.83. This is really zero, that put, but the call's continuing to go up. So that was solid. It's a solid way to get into an option and have a good chance of winning. You only paid 50 cents for the spread, and then you kind of have when the front months expire, then you have just what's left on those outer tents. Were you going to say something, Ted?
I was going to say the reason you're not seeing the short legs there is because they expired on the 22nd.
Right. It's a 26 now. So yeah, exactly.
All right.
So yeah, so those did really well. So it's a good way, on a cheap double calendar to let the front expire and see what happens to the calls or puts that you are long. So market happened to rally. We did well on that. So that's how we did on that one. Let's look at the SPY kind. So here was that 349 cost. And now it's worth 135 with the stock's only up like a buck over the $1.33 over the strike. So again, if we were to be exercise, we're just going to let it go. It expires on the 29th, and we're going to let it go. If it expires underneath 474, we're just going to accept the shares and sell. I believe it was a 70 delta call. We can go back and check out that back test, but that's what we're doing. We've been very fortunate to sell these puts right around 349. We've probably sold, 4 or 5 of them, and at similar values. And so this has done real well. So we're doing okay on that trade, Tyler.
Sounds good.
All right.
Thanks, Matt. So yeah, this week we're going to look at how to profit from a rising slope. Matt, I think you have a stock picked out that we want to look at.
Yeah, so we just earlier, to save some time, searched for a stock. We're actually looking for a put call slope, and then we're also looking for a volatility that we expect to go up, and I'll show you why. So let's talk about slope and what that means. It's called skew in the industry. Anyway, the stock is KRE, and KRE has what we would call a shallow slope. So what that means is we draw a tangent, we draw a line, and the slope is that rise over run. And so we expect this to go to the dashed line. So we expect this to get much steeper. And so then the question becomes, how do we set up a trade in order to do that? And that's what we're going to be doing today. So we expect these options on the low strikes to go up in IV and these to come down. And so it'll look, so the skew will look, a lot different than it is right now. Does that make sense, Tyler?
Yeah, and that's a neat graph right there. So we're showing the skew of every week, kind of right next to the skew of the next week and the week after that. So we're showing the macro kind of term structure of the options chain, and then we're looking at also the skew of each one. So it's a great way to see sort of at a glance, and then really dive into what you want to see.
Yeah, good point. And this is how many days? So this is 32 days. You can kind of tell too. So we do have slope here, and one of the things that we do see is slope will get flatter as it gets towards expiration. So and maybe the cause of that, people want these puts out here. They don't know what's going to happen, but as it gets a little bit more stable, they aren't as dear, and so they'll roll out, probably sell these puts, and buy puts that are in later months. So this is 94 days. You can tell that's getting steeper, even though 2.3 isn't that steep for this particular stock. So now the challenge becomes, okay, so how do we find a strategy that will benefit from a rise in slope? All right, so let's go to the option scanner and check out what our thesis we have, and now how do we implement our thesis? Meaning, how could we find we want to buy low strikes and sell high strikes, but not have a large delta. So, for example, if we had long stock, so this is a graphical long stock, again, with the stock price going down and the stock price going up, this is just a long stock. So every dollar the stock goes up, you make $1. Every dollar the stock goes down, you lose $1. So this is the typical payoff picture. And then the way a caller works is you would sell this, and so you wouldn't have this anymore. And you would buy a put down here. So you'd sell a call up there. So you'd give away some of this upside, and you would buy a put, and you would protect yourself from some of the downside. So that's typically, and then again, if the skew goes up, the price of this one will go up, and the skew will fall for the call, and that would typically help a caller out. The problem is with this long stock, you have such long deltas. For example, the net delta after all this is quite positive. So what we want to do is construct something that doesn't have that long of a delta. And the way we'll do that is we will do it with a call. So let's start over again. We'll do it with a deep in the money call. So if the at the money is right around here, we'll buy a call here, and then let's just make this 0. We'll buy a call down here, and then we'll sell a call up here, but we'll also buy a put. So we'll flatten it out this way. And since we're buying a call and not stock, that's less deltas. So that'll tend to flatten us out. And then we'll need to find a long call and a long put. Sorry, short call and a long put that will kind of net out to be about a zero delta. So I know that's a lot to say, but let's try it out.
I think it's a little, we can visualize this, also if you scan for a short risk reversal, it kind of has the same payoff structure as the call you're talking about. So maybe that's a better way to visualize it.
Yeah. So what Tyler's talking about is a short risk reversal, right? Because a risk reversal is just doing something else. So this risk reversal. So let's just see. So here's a risk reversal in KRE, right? And again, you could do those for generally pretty cheap, but the delta on this one's negative 57. So if you were to buy stock on top of this, this is 100 delta, so that you buy 100 shares against each contract. So you'd still be long 43 deltas, which is a lot of deltas to be long against this. You'd still have that, what we're looking for. You'd be long the low strike and short the high strike. And that will benefit from this skew change that we're looking for. But you don't want to have those deltas just for this thesis that we have. So the way to get rid of that thesis, so I'm going to close that and clear this trade out, is to buy an in-the-money call. So we set up, we have this new feature where we could just make our own strategy. So you say, okay, we're going to be long one call, that's over here, short one put, so it's going to drop down, and then long one put, and so that's there, and then we're not going to do that one. So that's how you start the process out. But now this long call, our default, now this is going to be a much deeper call, so we're going to buy about an 80 delta, and we're going to sell a 40 delta, so that's a net 40 delta long call spread essentially. And then, so we're long, so we want to buy a put. Now, I want to make the case for, we want to be slightly long in this strategy. And the reason is because it'll become a little bit more clear now, because it's long Vega, meaning if volatility goes up, we make money. So let's just take a look, and then I'll show you why I say it like that. So now, so here's our long call here. That's about an 82 delta. Here's our short call. That's a negative 44. So that minus that is plus or minus the 30 it's a 7 delta. So slightly long, which is what we want, and I'll show you why. This is one of the results. So we could look some other results later, but that's one of the results. So let's take a look at this trade. So we're long this deep call, we're long this put, and we're long this call, and that net delta is right here. So it says 3 on here, it's 7 above, so it's somewhere in between there. Slightly different calculations on each of these graphs. And we have slightly long Vega. So what's going to happen is, as the stock goes up, if volatility comes down, that's going to work against us. So that's why we want to be slightly long in the strategy. So to offset that, and we could model it out. So if volatility comes down, you could see that it's just barely below here and below here. But what's generally will happen when the stock starts coming down, volatility will actually increase. So we'll go up now, and you can see now that this purple line is above today's payoff. So if the volatility goes up, we're very happy with this move. Does that make sense, Tyler?
That's my favorite part about this strategy, is you're tackling so many of the shortcomings of the regular caller strategy, right, with this technique, because you're basically you're long delta, right? So you're getting more money as the stock goes up, but you're also long Vega. So if the stock goes down, well, you're losing money to the delta, but you're gaining money because of your Vega. So it's really a best of both worlds situation there.
Right. And our original thesis is we expect this green C buy and this green P buy put, we expect those to go up relative to the short that we have. So we want that skew to change as that all happens. And then we have kind of a normal payout picture, but we'll make money if that happens. And then also we're long Vega, we kind of in this particular ETF, we think the volatility is low relative to our forecast, so we have that in our favor as well.
One thing I want to point out here, Matt, is someone might ask, well, this custom scan looks a lot like a put 1x2 back spread, right? The payoff looks very similar to the 1x2, yeah, that one right there. But there's a reason why this one is more designed. There's a reason why this strategy is better designed to profit off of the change in slope.
Right. So you bring up a good point. So in a 1x2 back spread, you're right, and this looks a lot like the prior case of the caller, with a kind of the red here, or the terminal value. If it lands here at expiration, this is where you would lose, and it's slightly high Vega. The problem with this one is it's generally got a short delta. How you set this up is generally a short delta, difficult to set up otherwise, and it's generally got more Vega to it since your put is right here. So it's hard to get that trade-off right, which is why we've kind of come up with this custom strategy that, like I said, is a deep in the money put, not too deep, not a 90 delta, not a 95 delta, but an 80. Selling a call, you're not selling a 20 delta call, you're selling 40 delta, so you could get the right amount of delta. So when you buy that put, it has the most differences in the strikes, and that will give you the most bang for your buck if the skew changes, but also the delta that we want, which is basically a flat delta that we talked about before because of the volatility changes. So that's what we're after. So hopefully that answered that 1x2 put spread, the difference between the payout picture and the resultant Greeks from a 1x2 put back spread versus this what we call a caller.
Well, you mentioned the getting the most bang for your buck with the skew. Can you kind of dive into why that is? And it has something to do with how the deltas are going to change, right, as the skew changes.
Well, really, what you want is the biggest differences between deltas, or the biggest differences between these low strikes and this high strike. So the average between 51 and 49 is, so you kind of own two at 50 here, and you're selling the 55. Now this is the 51, 54. So the one that we liked was, and then this one's even, that's about the same, it's just a little wider. So either one of these two, right, average out at a 50. And so, so we like something like this. So I would choose something like, let's take a look at this. Bucks, wide thing. Yeah. So, so
you're looking at the difference between the long call strike and the short call strike, right? Because as the skew, we're sort of forecasting that the skew is going to change. It's going to kind of shift in this direction, right?
Right. It's funny because I was just in my head saying, well, the average of this equals 50, but this put, though, I'd rather have the absolute difference be better. I don't know if that makes sense, but so you want it's 55 minus 49, 55 minus 51. So this one looks a little bit better to me because you want your longs as far out away from zero, and you want your calls as far away from zero, but still maintaining a good delta, which I think slightly long delta is gonna be what we're looking for. So that's kind of why I like this setup.
Gotcha. And that's how you're set up to maximize from the change in skew that we're sort of forecasting.
Exactly, while still maintaining a flat payoff picture. But the thing I like about this payoff picture is there's a lot of places to win all the way over here and down here, and if volatility goes up, so we still put some things in our favor. But yeah, I mean we're really, the one thesis that we have is skew changing in our favor, where these low strikes go up and this high strike comes down. And then the other thing that we have slightly in our favor is if volatility goes up, we do well. There's not much Vega out here. Well, let's just look at it. So as you get up and out here, the Vega goes down, and you can see the Vega changing as I move to different stock prices, which is a really neat feature of this payout picture. So what we have is, I think, an ideal setup to take advantage of slope, and then we could also take advantage of volatility going up, and we don't get too hurt if volatility comes down. So that's why in this case, and the reason that we started talking about this when we were designing this for the show is that the volatility of the entire market was really low, and we were calling for the volatility and the skew were low, but especially the skew. And so what's happened is the skew has actually come back up. So it's not as cheap as it was before, but still there are some stocks like KRE that haven't followed the market skew back up, and it's still at pretty good skew lows, if that makes sense. So
It does, yeah. So you can typically, you can scan for these type of stocks, or you can look in the outlook to sort of see, what ORATS thinks is going to happen based on our forecast of slope and IV and a bunch of our other indicators.
you want to take a look at in Outlook right now?
Yeah, we can go to the outlook. You just see it's going to show you the kind of the graph of slope versus the components, and then kind of where we think we're bullish on IV and slope.
Yeah, so here's IV coming down. Here's IV versus the KRE components. So we're bullish on IV for a couple reasons, and then contango, and then here's slope. So we're bullish on slope for the reasons that we write about here.
Okay.
So why don't we go ahead and put this trade on and check it out and see how we do next week. We'll give them 3 cents. So our smooth edge. So we have this worth $4.98, but we'll pay just to get it filled. Like we could probably get filled right around here at $5. And then we have distribution edges. That's valuing this at each one of the nodes times the percentages. So it's the expected value, and we have a forecast that we could talk about in a different show, but it's just forecast volatility, skew, and long-term volatility, which probably the skew is probably the reason why it's we have it worth $5.25 and we're buying it for $5. That's kind of what we're looking for. So I would want maybe not too much profit, maybe a 10% profit in this, so we could just add an alert and then look for just a 10% profit and see what to do there. And then we'll just put a note to ourselves that this is on the Tradier Hub show, and it's a skew trade. Force this, so you could send it in. ORATS has a paper trading, so we're sending this to a paper trade. We could also send it to other brokers, but we're just doing it in the paper. And then you could send it as a market order, where you get filled most likely on the ask, limit order, where you have a chance of getting filled depending on where you are in the bid-ask spread. So we have a formula for doing that, or I'll just force it So we make sure we get filled, and I think it's quite likely that we would get filled in the market at this price. So let's send that, and we'll watch it. We'll watch it next week. All right. Anything else, Tyler?
No, that was great, Matt. One of my favorite trades we've covered so far, just because it's so unique and it really utilizes our tools and our forecasts and our indicators. If anyone has any comments or thoughts about the trade, let us know in the comments. We'd be happy to discuss the trade, and we look forward to seeing how it does. So yeah, thank you, Trader, for hosting us, and you can always check out our tools on orats.com. We'll see you guys next week.